You know, Eric, on this show, time and time again, founders talk about the importance of hiring great employees.
And they always say it's so hard and so important early on to hire the right person.
It makes a lot of sense that it's difficult because most founders don't have experience doing high-level searches or hiring top-level talent.
And they're also limited to their local talent pool a lot of the times.
That's why a lot of founders choose to work with SPMB, one of the fastest growing executive search firms in the country. For over 40 years, SPMB has specialized in recruiting upper management and board members to early stage VC-funded startups and larger growth stage companies too.
They bring the knowledge of a large global firm and combine it with the personalized service and attention of a boutique.
They have a dedicated team focusing on the Mountain West and Midwest emerging tech markets, so no matter where you are in the country, if you're trying to hire top-level talent, SPMB can help you out.
If that sounds like you can go to upside.fm/SPMB to learn how they are closing hundreds of C-level searches annually.
Nearly 50% of the capital that we deployed in the past 12 months through the retail side of our business came from repeat investor, which is incredible for us.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside. Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm your host, Jay Klaus, and I'm accompanied by your co-host, Mr. Private Markets himself, Eric Hornung.
I just hide in the shadows, Jay. Don't put me out in public.
It's just so much privacy.
I know.
What I'm trying to get at with this nickname, Mr. Private Markets himself, is that you have a lot of opinions on the accessibility of private markets.
I do have a lot of opinions on private markets. I think that we're in a really interesting place where over the last 100 years, there's been a lot of regulation to get rid of accessibility in private markets. And a lot of that was for good reason. I think it was well-intentioned. Hey, let's set everything up publicly. Let's make it available for investors so they don't get screwed. There was rampant fraud and corruption through the 1800s and early 1900s and mid 1900s and late 1900s. But,
all the way to today.
I think things got better. And whenever there's one problem, there tends to be a solution. And the solution has always been more regulation. And to date, that regulation has pushed everybody into the public markets so much so that all of the high investment return potential, not all of, a lot of, has moved into the private markets. So now we see a reversal of people saying, hey, there's less public companies to invest in. I want to go invest in some private companies. I want to go do venture capital or private equity or whatever it looks like. And we're seeing those buttons be pushed. It's very exciting because technology and media and accessibility are all these kind of macro trends that I think are going to drive the next 100 years and blur the lines between what is a public and private market investment.
And I'm here for it. I am an aspiring accredited investor, but technically not an accredited investor. And so as much as I think about and talk about this stuff, I can't actually participate in the old school way of investing in private markets. It's so frustrating.
But that's one of the great things about this kind of snapback on regulation is the Jobs Act started the path of opening up private market investments to people like you, Jay.
People like me and people like our guest today, who is far beyond that, actually not like me at all. His name is Ken Nguyen. He is the co-founder and CEO of Republic. Republic empowers everyone to invest in the future they believe in by providing access to startups, real estate, crypto, and video game investments. Focused on creating a diverse, sustainable, connected world, Republic has facilitated over $600 million in investments from over 1 million global community members.
So today we're going to be looking at equity crowdfunding. We're going to be learning about the model, talking about the history of Republic. It's something we've talked about loosely on this podcast, Jay, but we've never talked to one of the kind of big name platforms. Republic's up there. It's one of probably the top 3 or 4, I would say, by both volume and reputation. And I think they're on the leading edge of the present when it comes to what private markets look, especially under a Reg CF construct.
I have personally invested in 3 companies on Republic, which you can see on my profile at republic.co/J-Klaus, because they won't let me get rid of the hyphen. Those companies are Gumroad, Backstage Capital, and Maven. And I liked it, Eric. It was a fun little experience, and both Backstage Capital and Gumroad hit that marketplace or made their fundraising available right as the SEC allowed the Reg CF funding to go from a maximum $1 million per year to a maximum $5 million per year. Great timing.
And I think that's going to change a lot about Reg CF. It's going to open it up to larger and larger types of investments. So historically, you've seen very specific types of investments on equity crowdfunding sites. I'm guessing, and this is my future cast, that in the next 3 to 5 years, we'll see a bevy of different types of investments on things like Republic.
Prior to starting Republic, Ken was the general counsel at AngelList from 2014 to 2016, a very interesting gig. Eric, it seems like Ken has been living this one life he has to live the best way that he can.
And if you, dear listener, want to live the one life you have the best way you can go to upside.fm/ethos and learn more from our friends at Ethos Wealth Management.
Well, I'm excited to see what Ken has to say about the future of private market investing. We'd love to hear your thoughts on this episode as you listen. You can tweet at us at UpsideFM or email us hello@upside.fm, and we'll get to that interview with Ken right after this.
I hate that we've demonized scheduling links, Jay.
Scheduling links are actually one of my favorite things. I love the ease of someone saying, here's when you can book a time with me, and then I can choose when it's best for me too.
Whenever I get an outreach and someone says, what time looks good for you? I ask them, hey, do you have a scheduling tool? And you know what scheduling tool I wish they had?
Which one is that?
It's a new scheduling tool called Savvycal. Savvycal makes it easy for both parties to find the best time to meet.
Savvycal makes the scheduling process even more savvy than any other scheduling tool that I've seen, and I mean that. It makes it so easy to personalize your link. You can say, hey, this is a meeting time for Jay and Eric, and it just looks so professional, so sophisticated.
So much so that we're going to be using it for Upside going forward, and maybe even rolling it out to the Upside network.
You can use Savvycal as well. You can sign up for a free account at savvycal.com/upside. That's SAVVYCAL.com/upside. And when you're ready to upgrade to a paid plan, you can use the promo code UPSIDE for a free month. Ken, grateful to have you with us here today. I'd love to start this conversation by going back to your time at AngelList. Can you talk a little bit about how you got involved with the team there and what your role looked like?
Jay, thank you so much for having me today. That's an awesome question going back, into down memory lane. Naval and the team took a bet on me and brought me on as the first non-engineer hire at AngelList. The cultural fit, the pace of the company, everything was an adjustment for me coming from law and finance before that. But without that, I wouldn't have had the path down entrepreneurship and building Republic that I had today. It was an incredible 2 years, and the learning, the lessons remain today.
What was the problem that they were trying to solve by bringing on a non-engineer hire?
Well, AngelList started out simply as a not messaging board, but an educational tool for fundraising, right? It started out as Venture Hacks. It's a blog teaching entrepreneurs what's behind the curtain when you go out there and pitch VCs. Then after a couple of years of tremendous interest and a following for that blog, they decided to launch an investment product called syndication. That is pooling capital from individuals accredited, that is millionaires, and then find investment opportunities and deploy this pooled capital into companies. When you introduce an investment product to the market, naturally you have to deal with regulatory compliance and all of a sudden the necessity for internal and external legal expertise arise.
So you were instrumental in building out what is now AngelList Syndicates. Is that correct?
I was very, very early on in shaping it and launching variations of that syndication product. I didn't come up with the very first syndication, but almost from day two, what it then evolved to become, backers fund, rolling fund, access fund, international fund, the V2 to V6 of it. I was either heavily involved or the person who ideated and shipped it. And now, I left in 2016. There have been, countless iterations since, and it continues to be dominating the syndication landscape of Silicon Valley and beyond.
If I'm a lawyer around 2014, this sounds like an awesome job. And I'd imagine you would have a lot of competition for this role. So how did you become aware that this role existed? Or how did it become Ken Nguyen as our guy versus somebody else?
Jay, I have a rather unusual professional track for a lawyer. So I started out as a securities attorney at Goodwin Procter. Now it's just called Goodwin. And then went in-house at a large asset management fund in New York, at a hedge fund with over $40 billion under management. After a couple of years, went back to Palo Alto for legal academia. So by a stroke of luck, the senior faculty member, who was my boss effectively at Stanford Law, was an advisor to AngelList. And if you guys remember at the time, this is a couple of years past the Great Recession, the 28 global recession, the Obama administration was pushing through a series of new regulations, including a piece of law that made it possible for Republic to do what we do today, which is how to let non-accredited folks, everyday people, investing in private securities. But that early phase of 2012 to 2015, there was a lot of lobbying, regulatory relations, and it was a changing landscape for everyone in the space. And again, so much about life is luck and timing is luck, that I happened to be in Silicon Valley, knowing the people who knew Naval and AngelList. And next thing, I knew, I ended up joining them, which I gotta say, I wasn't out on a search to join AngelList. It was, it walked into my door.
Just to clarify, we're talking about the Jobs Act, right?
Yes, the Jobs Act is a big framework of regulatory improvements. Part of the Jobs Act included provisions that were relevant to what AngelList was doing and what Republic ended up doing. But the Jobs Act itself is a big body of law.
And when that was happening, when these relevant regulations were happening, how much of that was AngelList or people around AngelList lobbying for versus AngelList looking around and saying, oh, wow, this is great for us?
The lobbying effort behind the Jobs Act was an industry effort, but AngelList played a key role. Naval was at the Rose Garden with President Obama signing that body of law into place, signifying the deep involvement that he and AngelList had. We weren't the only one. There were at least another dozen industry partners playing a role in seeing that through. But a new law is limited in words, in context, in implications. And so what to do with it and the uncertainty of it, now that's up to different folks in the space to decide for themselves, to take the requisite risk for themselves and to continue the conversation with regulators. And I think that's what AngelList has been doing so well. And we brought some of that heritage over to Republic and continued it down our path.
So how did you decide to launch Republic? And if I'm remembering the Jobs Act correctly, focus on Reg CF.
When I joined AngelList, the thing that stood out to me was that coming from the hedge fund, New York, Wall Street world, how incredibly accessible it was, because the dollar amount that I used to help move when I was in New York was, 6, 7, 8 zeros attached to them at once. And then I'm the last one of five in my family. My oldest siblings were professionals, doctors, etc., and clearly middle class with some disposable income, living in Silicon Valley, and could not access any of this. So AngelList, the marketization model, the access and inclusion model really spoke out to me. Now, after 2+ years of doing that, the limitation also became very clear, because very few people are accredited. And the reality is, it doesn't make sense that why wouldn't a student be able to go down to Vegas and spend $100 at the lottery buying, playing the slot machines or buying lottery ticket, but not put $10 in his roommate business idea? So the potential of non-accredited access, of not limiting the gateway to just millionaires, really amplify the mission and the potential of what got me to AngelList to begin with. And that was basically the driving force and the conviction for the future potential of what Republic can be.
Yeah, I'm trying to think, I'm thinking back to that time frame. Was there an activating event around 2016? Because the Jobs Act was a little bit before, and you left to start Republic in 2016. Was there some other activating event legislatively that made Republic possible past that Jobs Act framework?
I'll give a 30-second crash course on the regulatory process. So after lobbying and getting Congress and the president to sign a new piece of law into law, oftentimes the law would require the regulatory agency, in this case, the SEC, but it could have been the IRS or a different division, Department of Homeland Security. In this case, the law required that the SEC would consider and implement appropriate regulations and framework to effectuate the intention of the law. So the law would say, hey, now you go and figure out the details, but we want this to happen. And they took another 2+ years in order to build that framework and launched it. So non-accredited investing under the Jobs Act was not implemented until May 16, 2016.
So how did you plan your own timing here? Because obviously you're aware this legislation is coming, and you're savvy enough to know that there's probably a first mover's advantage here, but who knows how long it's going to take to effectuate this law. So how did you plan your own exit and launch this company when the timing dependency is on a bunch of people that you don't directly have control over?
Well, we planned for it, but we missed the window. Jay, Republic wasn't the first platform to launch immediately upon the effective day of the Jobs Act or the Reg CF, Regulation Crowdfunding. WeFunder, Start Engine, Seed Invest, Nextseed, at least 8 other platforms prepped for it and timed it perfectly, because I was also building Republic. I was also at AngelList at the time, and there were other priorities, other initiatives and projects. And the conversation with AngelList about me leaving and doing my own thing also grew its own legs, so to speak, and took a run around the block. So we didn't launch until July 18, 2016. Literally just celebrated our 5-year anniversary last week. But in hindsight, I wouldn't change a thing. Obviously, there would have been a first mover advantage, but there were so many other platforms that knew about this. And so there were first movers, plural, but there wasn't a single first mover advantage. So at the end of the day, I'm not sure how much of that actually mattered.
So when you have those kind of extra years, I think a couple of the names you mentioned, they were founded in the 2012-ish timeframe. You have those couple of extra years. You got the chance to create Republic as something different, I would assume, than the competitors. How did you think about differentiation as you were entering a market where there was already people who were first movers?
Eric, we had a couple of months. We funded Seed Investor Engine all did or wanted to do what AngelList was doing. They've been around for nearly as long as AngelList. Now, I gotta admit, focused after the first couple years, probably thinking that, all right, it's not possible or that we don't want to compete with AngelList. And our conviction is more on the non-accredited, the full democratization of venture investing, and they planned early. So when they all launched in May 2016, and we were still building our platform from scratch, the advantage we had over that 2 months, almost exactly 2 months, was defining on why we're different. If we were just doing the same thing and believing in the same thing, I would just go and ask Howard Marks for a job or Ryan at Seed Invest for a job. If not a co-founder, then maybe a GC. Of course, we believe that we're different. And of course, we believe that we're going to win the game. And how is it so? And being able to take a step back, look at what everyone was doing and telling the world and refined why we're authentically different ended up being a crucial advantage. Had we been out with everyone else and just in the rat race, I don't know that we would have had that, half a day to really think about it. And the value of these things are hard to quantify that day or even that month. Only in hindsight, with a little bit of time, the value of brand, of messaging, and of mission amplify enough for you to see.
Let's dive into that a bit. What is the brand, the value, and the mission of Republic, and how is that different than the rest of the industry?
Well, first of all, let me define our brand first, and then let me dive in on why it's different. The Republic brand and everything that we do, even down today, is very much around access and inclusion, not necessarily as a moral high ground, but as a fairness concept and a core belief that if what you see is a function of where you sit, then a team, a group of investors, a company with team members that see more of the whole landscape necessarily would make better decisions. So out of the notion of believing in that, believing in access and inclusion, that we shaped Republic, and we came from a company that also believed in democratization, but to a certain limit, right? So we wanted to make sure that we focus on deals, on business activities, on market positioning in a way that would be so strong and so clear that we here to push access and inclusion first and foremost, and everything else would sprout out of that. Return on investment, social capital, everything else. Not the reverse, not picking the hottest company and then saying that, all right, we're also about access and inclusion. So we reversed the script, and at the beginning did not focus on the YC company, on the AngelList tech companies, but instead focus on stories that had a core mission statement, unmistakable, STEM for young girls. Clothing. At the time, I don't know if you guys remember the Zika pandemic, the mosquitoes bite. Yeah, a company that would make clothes for pregnant women in countries infested with Zika. That kind of story, just to show that the startups, the stories, the innovations feature on Republic are those that people can relate to beyond just return on investment. Again, this was just the very beginning of Republic. And then as we grew, after we proved that once you get people's heart, of course, you got to make sure that you have to account for their pocket down the road as well. It can't just be feel good. It got to be do good and do well.
You guys are building a marketplace platform here. So in the early days when you're building this marketplace, that to me, you're talking about the type of person in terms of the type of investor you're appealing to. You're talking about the type of company that you bring on the platform. But how did you actually get people to come at the platform in the right proportion to build a marketplace here that still exists 5 years later?
What makes Republic business model one of the more challenging, difficult business models to build is that it's a two-sided marketplace in a market that did not exist. So you have to try to generate the market on both sides, hoping that there would be enough business traction to keep the lights on. It's a combination of partners like AngelList, She Works, Women 2.0, evangelizing for us, getting the word out, and a portion of everyone on the team and myself, every opportunity that we had, whether it's at a conference, at a coffee shop, certainly podcast. That's why I value our media partners so much. And a lot of that is each company that we brought on with such a strong message, and founders and the early teams of those companies are people who believe passionately in what they do and also help amplify for their business, and why the model of community investing is the next thing. So if it takes a village to raise a child, and it indeed took the entire community to get Republic through its first year, I very much believe that the only way for this to get true global adoption, media gotta be a long-term partner for us. It has been since day one, and I think it will always be a key partner.
I would imagine that a lot of your investors that come on the platform are brought in because of a specific deal that they see that they're interested in. That's probably an entry point. Is that fair to say?
Not necessarily. We actually have about 5 times the amount of registered users, meaning those who come to us are interested enough in what we do, signed up and do KYC AML, but have yet to make an investment. So only about 20% of our user base have actually deployed capital into deals. The narrative around it, Jay, is compelling enough that most people, once they know about it, they want to check it out, which is, if your dollar matters, wouldn't you want to have a role in deciding which company will become the next Amazon and Uber and the influencers in the global economy? Or do you want to let banks and Peter Thiel and Elon Musk, as much as we love them, to make these decisions? So that choice, that empowerment, definitely captures most people's attention. Even high school students who cannot invest on Republic, they reach out to us all the time. But it is daunting once you get on the platform and look at a deal page. Most people, including accredited folks, have never invested privately before. So you're talking about having to understand the concept of equity versus debt. What's a crowd save? It's a lot for people to focus their attention on. So we gotta go through and deploy resources on what we call user activation and retention. How do you activate and turn someone's interest into action? And how do you encourage people to act again and again?
It feels like that's related to the type of companies we see on equity crowdfunding sites. I know that this is kind of changing now. I think you guys just did maybe, but for the most part, it feels like it's a lot of consumer tech, a lot of products, things that maybe you don't see in a traditional venture capital portfolio. Have you noticed that there's a different type of company that gets funded on an equity crowdfunding site versus maybe a traditional bread and butter VC?
The percentage of consumer tech or consumer good and services companies availing themselves of retail investing Probably, I would say 20 to 25%. I don't have the exact percentage in front of me today. At the very beginning, it was 90% because, if you're trying to build a company or in a market in the consumer space and your primary customer is a non-accredited person, of course, it got to be something that is relatable, understandable to your customer or your ideal customer. But over time now, we have, and our investor base has grown larger, but also more sophisticated. And as such, they can assess deals and have an interest and a demand for deals that certainly would be a complete failure in year one.
You said about 20% of your user base has deployed capital.
Even less.
Even
I don't have
less.
the exact percentage yet.
Around there. How does that break down to people who have invested in more than one company?
So yes, the goal on our end is that people would invest at one point into 50 companies, 100 companies or so. But to give you an example, don't quote me on the exact math here, but nearly 50% of the capital that we deployed in the past 12 months through the retail side of our business came from repeat investor, which is incredible for us because that means that it's not just new investor coming in, taking an interest in one deal, make an investment and never come back. It's that they come, they stay, and they re-engage. Products that we're rolling out that allow people to hopefully repeat or reinvest at ease. Products like Autopilot, you can check a box, pick a few criteria that you find very compelling, and whenever there's a deal that fits those criteria, you're gonna get a notification and a reminder to deploy. One of many products to come. It's still so early on, but I have no doubt. And absolutely, diversification is key for any private investment strategy. So of course, we have to encourage and one day maybe even make sure that people fully understanding, if not quite requiring, that people invest in multiple deals. If you have $500 to invest, it should be in 20 deals, $25 a pop, and not in one $500 investment.
One of the things that I love about Republic and have loved since I found out about it, probably back in 2016, 2017, is just the dedication to like user interface and functionality. I find that the site's very well designed compared to especially what else is out there. How do you think about focusing on product, focusing on features like Autopilot, focusing on making it a better user experience versus underwriting new investments? Like, how's the team built out?
Thanks so much, Eric, for the generous feedback and UX product infrastructure. The focus on technology, on engineering, on design, that I inherited from AngelList, going back to Jay's question, because I started out my career as an attorney and I was at a large law firm and then at a hedge fund who are just notoriously bad on user experience and just look at their websites in general. I don't have a product background, but I've had incredible co-founders and the early team, and even today, who are incredibly talented. I didn't really, I think, even second guess anything in the first phase of product building at Republic in terms of logo, branding, UX, just trust it fully. One of my co-founders at the beginning was the chief product architect for AngelList itself. So there was a lot that we brought with us. At the end of the day, currently, some studies have said that people's attention span is less than 9 seconds before something else online would command their attention. That means that you gotta have an experience. After you say equity, crowdfunding, convertible note, and it will already take up half of the 9 seconds. You gotta simplify mainstream visually and procedurally the experience, and there's still a lot more to be done. But that's why it is so hard to do and build what we do what we have to date. The team that we have today is nearly 45 engineers and product designers spread it out over the world to keep the cost down, juggling that with an equal number of business development, deal ops team. And these people tend to have very different personalities, different background, and mesh them all together, have them duke it out and, define and decide on the optimal products for consumer. It makes for a very rowdy and at times testy and heated family. But I think that core mission, the clarity around why we do what we do, is what keeps everything together so well today.
Well, speaking of people's attention spans, Republic's been around for about 5 years at this point. Typically, a venture investment can take 10 years or more to return the fund. In crowdfunding like this, how important are people's expectations of when they may see a return on what they're deploying here? And do you have any stories to point to of that full cycle happening yet?
Education. That's the key for anyone out there showing investment products to investors. The disclaimers about how this is high risk and illiquid, you can only do so much, and people still would not fully appreciate it. And so you absolutely have to think of ways to provide that liquidity. There's no question that secondary trading is on our roadmap. I don't think I've shared it anywhere else. This is probably the first public announcement that Republic will enable secondary trading. The 8 to 10 year life cycle, and even though we've been out for 5 years, only in the past 2 years that the pace of business has picked up tremendously. So still very early on, but there, yes, have been incredible success stories. How about this? Robinhood went public last week. Republic accredited investor, a good number of them, were able to invest through Republic early on in 2020. I think maybe as early as 2019. And definitely we'll be seeing a significant upside and payday compared to those who invest in the public market either last week or will be investing. Second example, a platform in the UK called Cedars that deployed over $3 million into Revolut back in 2017, a crowd investing campaign, UK style. That company, I believe, closed around at $33 billion in valuation 2 weeks ago and raised something like 800 million. I don't know the exact multiple of that markup, but it's a hefty markup. Now, you mentioned, Jay, that we've been out for 5 years. I think it's the equivalent of 5 seconds into this whole new day. That is the potential of retail investing. And so these are incredibly encouraging signals for what to come. Republic, on our side, we still haven't seen a full exit on a retail, on a crowdfunding campaign or a company that crowdfunded and went public, but I have no doubt that will come down the road. Hopefully, though, people are going to be able to sell and trade and buy secondarily before that.
So when we talk about this concept of going mainstream in the retail investing space, I think it's fair to say that the type of investments that are on Republic would be generally categorized as alternative assets, which are a small piece of the overall pie of investable asset classes. When you're thinking about building out these future platforms, the secondary trading platform, how are you thinking about creating an ecosystem that's a Republic-only ecosystem versus plugging into the existing financial infrastructure, the wealth managers, the financial advisors, the SaaS products that service all of those?
The public market used to be much larger than the private market. That has changed. Right now, when you look at private equity, venture capital, real estate, and other major private markets, they're like 5 times the size of all of public company stock combined. The rise of alternative assets, again, this is just the beginning, but it is already larger. So oddly enough, alt is becoming mainstream. The script has been flipped or is being flipped. But within this whole universe of alternative assets, there are new ones coming up every day and being grown and tested. NFT, crypto is number one example, still very alternative. Many people still look at it, either know nothing about it or look at it without much credibility, not viewing it as a credible thing. But that narrative is changing as well. So with anything that's new, including venture financing democratized for retail investor, it will take a little bit of time for any subset of alternative assets to be large enough for it to get the interest of institutional capital partners, that is, those who can deploy billions and trillions of money. If they have that money to deploy, they need to put it in something that's worth their time. So in year 1 or year 2, if the entirety of the equity crowdfunding, I hate those words because it's just they sound misleading and ugly, but that's what it is, Reg CF. If the entirety of that was less than $50 million in total capital deployed, then how would the fidelity that everything they touch got to be in the billions would be seriously looking at it? But that's changing. We would not be surprised in 2022 or shortly after that we'll become the deal partner for the JP Morgan, the Goldman Sachs, the Fidelity, the Credit Suisse of the world, and not just about VC deals or private equity deals, but real estate, indeed game financing, and the world of tokenized assets and securities.
I was listening to your interview with Jason on This Week in Startups. So I know your model for somebody raising on Republic is a 6% cash return to Republic on a successful raise and a 2% upside in that return as well. Am I getting that correct?
Correct. By and large, the fee model, again, may change over time, but that's currently what we typically charge a company that comes to Republic for crowd financing.
So if you're thinking about the future of this company, where do you see the most upside if all things go really well? Are you looking at this giant portfolio of companies and the returns possible there?
So the upside from our retail deals would come to back the Republic Note token. We have our own proprietary revenue sharing token that is linked to the success of the companies raising through Republic. Of course, we very much believe in the value of our portfolio overall, but we know that is going to be a long term. And obviously, as a company, we also need capital to operate the company near term. That's why there's the carry and equity split. If we're given $1 billion by Jason, hi Jason, and not have to worry about budget and expense and where to finance, how to finance ourselves, I would take 100% in upside across the board.
Love that.
That's a good clip for us, Jay. Take 100% in upside.
I saw, recently you had 2 big raises under the new $5 million total fundraise provision. And actually, I invested in both those companies, both Gumroad and Backstage Capital. Talk about this change in the law allowing companies to raise up to $5 million on that Reg CF. And does that open the door to different types of companies, or is it just making fundraising a little bit easier for the ones who would already want to do equity crowdfunding?
Oh, it has done and will do so much. This arbitrary cap that no company could raise more than $1 million a year from retail customers, investors, general public, basically prevented all mature or more mature startups to go through the complexity, accounting, legal disclosure, regulatory filing, to raise, because $1 million didn't have the same impact proportionally to their business compared to a company newly launched or post-launch, but was still in an incubator and accelerator at Y Combinator, as an example. I never thought that my legal background before building Republic would be so incredibly helpful. But the reality is that when you have a new law like regulation crowdfunding, it's bound to be a beta version, and they gotta be version 2.0, 3.0, and beyond. And so the regulatory willingness and experience to continue driving that conversation with the SEC, with Congress, doesn't stop the day the law becomes implemented. It continues and is continuing. And so I would say over the years, a significant percentage of my time has been deployed not just to pounding the pavement on Capitol Hill, but also to gather industry data, private market information, and send them in through informal and formal submissions to the folks at the SECs and the different committees on the House and the Senate. And so we saw that law changed in March of this year, that's 5 months ago, and it has already shown tremendous potential. It will take a little while, Jay and Eric, for the more mature companies and their board and their general counsel. The bigger you are, the more those things become important. For those players to become quickly comfortable with retail investing and say, yeah, of course, do it. Because right now, when we talk to whoever that may be, they will be, all right, I love the idea. The founder would really be on it right away. But it would take a couple months to convince the lawyers and the board members, to inform them and to win them over. That sales cycle is going to get shorter though.
Well, you've definitely won us over here today. If people want to know more about Republic or where they can go to find out more about how they can launch their company on there, they can invest, where should they go?
Republic.co, not .com, .co. And, just find me on Twitter, on LinkedIn, Kendrick Nguyen. And I typically, respond to everyone within a week. If it's a really hectic week, it might take a little bit longer than that. But Eric and Jay, I'm so grateful again for your support and the support of our media partners, because that's the only one way to get people to know how easy, how credible, and why this is important for the future of venture capital, of technology in the US and beyond. The first 50 years of this industry that is venture capital is clearly a better product, given that humanity has been around for at least 5,000 years, if not more. There's no reason to assume what Sequoia or Peter Thiel did 10 years ago should be status quo. Even now, nothing that we're doing now will likely to be exactly the same 5 years from now. So if there's a moment for everyone to play a role in shaping the financing, the engine of innovation and future economy, why wouldn't they, right? As an entrepreneur or as a potential investors. And I think I can talk about it all day, but without you help spread the word, we wouldn't be here. The industry wouldn't have been here. So thank you so much for that.
Eric, do you know what my favorite part about podcast advertisements is?
That people actually listen to them?
Wow, you read my mind. It's almost like we've done this twice now. Yes, that people actually listen to them. Look, you're listening right now, dear listener.
And me, I'm listening too. I'm listening to you, Jay, here on the Upside Podcast.
And if you have a message that you want to share with the Upside audience, people who care about startups, investing, the middle of the country, this is a really great place to put that message.
Because people will listen to it. And if you have an event or you just want to get something out about your brand, you're hiring, this is the perfect place for the upside.fm/classifieds. That's our classified ad that can run on 1 to 5 podcast episodes.
That's right. Typically, we lock in sponsors for longer sponsorships, but we wanted to make this accessible to you and your message. If you have a message to share with our audience, go to upside.fm/classifieds and get your ad on the airwaves.
All right, Jay, we just got the leak from Ken. Again, just us at Upside. Man, I love that.
Yeah, we did. Secondary market trading on Republic. That seems like a big deal, Eric. That's going to really increase the trading volume on that platform, I imagine, and make the whole marketplace, in my opinion, more attractive, because the biggest shadow I have about this type of investing is liquidity and actually accessing the gains that you see here. And a secondary market would provide some of that.
It's amazing how much retail investors, that includes me and you, care about liquidity. You can't have something be locked up for 5, 10, 15 years in someone's portfolio. It's one of the reasons why historically a lot of the investments that are like that are limited to people with excessive amounts of money, because they can afford to keep that locked up over the side. And there's some really cool stuff. If you are a fan of Meb Faber, he runs the Meb Faber Show. Go check out that podcast. He talks about the idea of liquidity alpha all the time. Keeping things illiquid for a longer period of time, not touching them, is actually one of the biggest potential generators of alpha. So Jay, one of the things I liked about Ken was his commitment to access and inclusion, and how the model spoke to him, specifically how it came out of the limitations on AngelList. I thought that when he was talking about there's this potential for non-accredited access and how it aligned with his mission and amplified it, that to me feels very on brand for what's going to be happening in the next, for my version of what's going to be happening in the next 10, 20, 30 years.
Yeah, I like that he had the courage and the willingness to take the leap too, as opposed to trying to build it internally. You know, you can certainly see a world in the future where AngelList said, "Oh, that's a great idea, Ken. Why don't you build that here under AngelList?" Might have been de-risked a little bit, but even not being perfectly first to market amongst these platforms, because of that relationship, because of his track record and his experience there, it's allowed Republic to grow quite a bit and become one of the leading players in this space.
I think you and I are both peripheral fans of AngelList, what they've built, what they've done, and they tend to represent the very Silicon Valley way of entrepreneurship. So we don't overlap with them much on this podcast. That being said, very, very cool of them to let Ken go out, do his own thing, spin off, and take a lot of his experience and really build something, and also support him, it sounded like, when he did it.
I'm also a community guy, and the idea that nearly 9,500 people invested in Gumroad's $5 million campaign, probably a lot of them Gumroad users or customers. Similarly, almost 7,000 investors in Backstage Capital. These are all people that not only are giving you money, but they are lending their voice, they're lending their own platforms, they're probably advocating for the fundraise. Now they have a vested interest in your success. I think it's a really, really great marketing and distribution strategy for companies going on Republic, similar to the way that Kickstarter was in the early days. But the incentive here is even stronger, because you're not just pre-ordering a product, you ostensibly can see a long-term actual return on the financial investment you're making.
One of the biggest things that I think Republic has the ability to solve, and this is when the switch will flip, I believe. How familiar are you with what's happening with Tiger Global, Jay?
Not super.
Okay. So Tiger Global is a large multi-billion-dollar hedge fund that decided, hey, I'm going to get into venture capital. That's exactly how they did it too. They just said, I'm feeling it. And they came in and they decided they wanted to get into the hottest rounds, and they wanted to preempt everything, and they wanted to move faster than anybody else. So they shortened their due diligence windows. They moved fast. They overpriced rounds, and they've been doing that and disrupting the venture capital world. I don't think that the valuation aspect of their strategy is the most important. I think speed is. I think founders want to spend less time fundraising. So if Republic can be the source of having enough investors to close their fundraising round faster. You mentioned Gumroad. I think they closed in like a couple of hours. I think Arlen and Backstage closed in less than 24 hours. If when you launch on Republic, you're underwritten to close in a week without having to go through hundreds of VC presentations, that's when I think this model flips on and it becomes more the norm in the venture capital space. I think right now there's just too many equity crowdfunding campaigns that sit out there at 20% funded, that risk is scary to founders.
Yeah. And I know this is a coffee chat episode, but looking at Republic as a company and investment opportunity itself, I love that they have an ownership stake in all the companies that are raising on the platform. What a incredible portfolio they're building by existing and enabling this type of transaction. Like, that's incredible. And you heard Ken say, he's like, if it weren't for like the expenses of the business, he would take all of their cut in ownership of the companies on the platform.
It harkened back to our question to Peter Livingston about how he funds his syndicate. And he said, I'm very fortunate that I think he was in Bitcoin, like when it was sub 1,000. So he has the capital to run this thing for the next 5 to 10 years and can burn his own cash flow while the equity value of the things he's investing in hopefully becomes cash in the future. And I think when you look at some of the great compounders of all time, you look at the Buffetts, you look at the Bezoses, they kept their cash burn low and they focused on getting as much equity as possible. So I think it's a really smart decision, and hopefully they can figure out a way to take less cash and take more equity.
Well, dear listener, we'd love to hear if you have participated in Republic, if you have invested in a company on the platform, or what you think about the platform itself. You can tweet at us at UpsideFM or email us hello@upside.fm, and we'll talk to you again next week. That's all for this week. Thanks for listening. We'd love to hear what you think about this episode, so tweet at us at UpsideFM or email us hello@upside.fm and let us know. You can learn more about us and browse our entire back catalog of episodes at upside.fm. And if you love our show, please leave a review on Apple Podcasts. That goes a long way in helping us bring high-quality guests to the show.
Rocky and Sylvester. One for underrated, two for underpaid. Today I'm gonna